From wealthstack.ca, welcome to the Financial Wellness podcast series, where we discuss all kinds of financial principles, concepts, and products. Our aim is to make money matters simple again. What do you think about Bitcoin and cryptocurrency? Have you been fooled to buy it, or have you been avoiding it because you have been fooled? I'm Vincent, and in the studio today I have a very good friend of mine, Ian de Lange. Ian is the Chief Investment Officer of Seed Investments and manages 5 mutual funds. Ian reads widely and has a deep knowledge of the financial markets. In this show, we will unpack the main workings of Bitcoin, the reasons why people invest in it, what is backing Bitcoin, and is there an investment case for it? Welcome, Ian. It's great to have you on the show.
Great, Vincent. Excellent. Good to be with you. Thank you.
So let's just dive straight into it in terms of Bitcoin and how that differs from other cryptocurrencies. What is the main differences there for us?
The first thing to note is obviously that Bitcoin was and is the original blockchain that was invented all the way back in 2009. Everything else has come in on the back of Bitcoin, so-called alternative coins, and there's obviously a range of them. There are definitely differences. I can't say I know the ins and outs of all the differences, but there's some major differences that are obviously apparent. Some of the differences are, the big one is decentralization. Bitcoin is definitely a lot more decentralized, and that's a key component. All other alternative coins, including Ethereum, are decentralized, but not as decentralized as Bitcoin.
So let's just quickly go through this, the working of it. Why does it take so long or such a lot of effort to mine these Bitcoins, and how does it being added to the blockchain?
The miners are essentially rewarded, and the reward is an allocation of newly minted Bitcoin. That is the reward for actually putting in the cost. The cost is largely, obviously, the infrastructure cost, and the bulk of that cost is the operating cost, is the electricity cost. The reward for that is the newly minted Bitcoin. So as soon as a particular miner discovers the particular hash that meets the requirements, they will collate that block and get awarded with the currently 6.25 newly minted Bitcoin.
Just give me a sense again, there's a limitation in terms of the number of Bitcoins coming to the market. And how are we sure that the 21 doesn't become 25 and then next year 28?
Yes, I mean this is a key component and absolutely a key attribute of Bitcoin is obviously the so-called scarcity factor. And 21 is the absolute number, 21 million Bitcoins. The award started at 50, and every 4 years is halved. It's not exactly every 4 years. I think it's 210,000 blocks. Every 210,000 blocks or so, the reward is halved down. So 50 becomes 25, goes all the way down to 6.25 currently. Your key question there, yes, is how do we know that this cannot be changed? Well, as we know, this is, first of all, it's open source code. Anything can be changed, but the big issue is the run on a consensus basis. And so anyone is free at any time to go and change the algorithm, to go and change the code, print down their version of it, start their own version, change the numbers, and so move on. The problem, though, is that they are going to be the only ones running their code, and no one is going to actually join them. No one is incentivized. And so that consensus of the participants is so critical to the whole running of Bitcoin. There's a strong alignment of incentives, which keeps the thing very, and in fact, highly unlikely to actually be amended.
Ian, what happened in 2017? Maybe just give us a view of, exactly to that consensus, and people wanted to change something, and then it went south a little bit.
Yeah, so in 2017, they had what was called the block size wars. They had a sort of camp who wanted to increase the size of the blocks, be able to put more transactions through the system, And then you had the camp that said, no, we will remain as is. It's sufficiently designed as is. There was a hard fork, which meant that a fork veered off, took the protocol, amended it to increase the block size, and out of that sprung Bitcoin Cash. And then there's even been a further fork, I think, to Satoshi Vision or whatever. But clearly, the market ultimately decided who was the winner, and that has just come down and down and down and down in price relative to the original Bitcoin. So it just goes to show that yes, the protocol can be amended, but unless you've got the majority of participants moving along with that, effectively it's a vote of no confidence. And the participants, being the miners and the nodes, voted not only with their feet, but effectively voted with their wallets and said, we're not going to go. We're not going to, we don't really see value in this. Obviously, a few people did see value, but the vast majority didn't. And so this is what happens. And so I think going forward, we're not going to, it's not impossible, but it's unlikely that you're going to have this type of splitting out again.
And so that is the main difference why we talk about Bitcoin as opposed to cryptocurrencies, because all the other cryptocurrencies may use components or very similar kind of technology in terms of blockchain.
Yes.
But with Bitcoin, that is that sense of consensus will keep it at that 21 million coins, whereas the other cryptocurrencies are set up differently, and there's maybe not that backing of the limitation of the coins that's been issued.
I think that's fair to say. It's a big difference. I think the other issue is most of these other alternative coins, some of them have sort of split personality in a way, in that they're not necessarily trying to be the sort of monetary type of network, but in the case of something like Ethereum, which has definitely stood the test of time, it's actually trying to be more of a distributed computing system, as it were, as opposed to just a pure distribution of a network and only doing one thing and one thing only, and that's the ability to move value from one participant to another participant. So the Ethereum network, that's one of the major differences. It might not be, as I said earlier, it might not be as decentralized, but it's actually trying to achieve something different, and that's actually not necessarily a hard coding of the cap of 21 million units, or whatever the number is, more trying to look at being a distributed world computer.
So also, if we just look at Bitcoin versus some of the other stable currencies, it may obviously issue unlimited number of coins because it's backed by $1 or a yen or whatever the currency is, or any other stable kind of fiat currency behind it. And so that's the difference between a stable coin and Bitcoin again. Bitcoin is backed by consensus of developers, effectively open source developers that look at the code and give their consensus, where some of the stable currencies are obviously then more backed by the currency, but there could be an unlimited number of coins being issued. Is that fair to say?
I think that is fair to say. There is definitely, it does appear to be a use case for these so-called stable coins, such as Tether, whereby they are presumably backed by currency, but they effectively then work as a digital token that, given the rails of the sort of blockchain technology, a lot easier to move these around the world as opposed to the traditional fiat system using the sort of legacy banking system. And so there's definitely been a huge uptick in demand for stablecoins such as Tether, especially from emerging markets where a lot of individuals are keen to get out of their currency. In emerging markets where there's obviously a lot of concern given the stability of those currencies and into the dollar, and it's a lot easier to move into, let's say, the Tether, which then tracks the dollar one for one on a like-for-like basis. As to the backing of that, well, I think this is clearly what's of concern to governments around the world, especially the US government now, and so that's definitely something that's valid. I believe they need to look at this and try and understand this.
There must be a level of distrust in the market or distrust in financial system, why people find a new way of trading. I thought about the old days of, I give you a goat and you give me milk kind of thing. And then people obviously went to gold and coins and what we have today. It just kind of feel that, the financial system changed the last 50 years more than the previous centuries.
Look, I mean, I think that's absolutely correct, and obviously, we're in this new digital age when there's so much that is getting effectively digitized, from an analog world to a digital world, and so in many ways, sort of your store of value or the means of transferring value one to another was done more on an analog basis, and now it's moving pretty rapidly in many ways to a digital environment. And in many ways, we've sort of had this digital environment, but I think it's run on the rails of legacy, let's say, banking system. Many people haven't really seen necessarily maybe a need to actually upgrade, but along came the sort of digitization, so to speak, of value, especially with Bitcoin, and then all these other, there's been so much adoption, I think, on top of that, but it's still relatively early days in so many ways. So many people are trying to grapple with this. Obviously, is it a proper store of value? Is there something there? Clearly, the intangibility of it concerns so many people, because when you think of value, we think of something more tangible, so to speak. Even if it's a share certificate, but there's something tangible behind it. There's a company, it's people, it's making proper goods. It's something that's purely intangible is very difficult for so many people to wrap their head around. Bitcoin, effectively, what has been achieved has been digital scarcity. Because with digital, as we know, you can make unlimited copies of your email. You can take a photo, you can make unlimited versions of your photo. What's the original and what's the copy? I mean, it's exactly one-for-one replication. But the methodology that was actually achieved what so many people have been working on for such a long period of time, trying to figure out how do we achieve in a digital world this scarcity.
So let's just quickly talk about the history of transacting. And we don't have to go that far back. We had the gold standard till, when was that, 1971? All the currencies issued was backed by gold. And then we broke away from gold, and that was a big shift, moving away from something stable behind a currency. Correct. Into what is known into a fiat currency now.
No, that's right. So I think over many decades and centuries, I think the gold came to obviously represent good money in so many ways, durability, even a degree of portability because it's pretty dense. And the biggest factor was scarcity. So the scarcity factor, the world settled pretty much on gold in so many ways. And it did, first of all, obviously gold coins were used, and then eventually a paper currency on the top of gold as the base layer. But slowly, I think, as we saw, that got unwound. Bretton Woods was obviously post the Second World War. The idea was, okay, we'll have the dollar as the standard, but the dollar is back to gold, and then everything was basically set to the dollar. But essentially you had the backing. And as you say, that went all the way to 1971. And effectively Nixon had no real choice but to take the dollar off the gold standard because the US was getting, their store of gold was getting depleted. The French were effectively saying, give us our gold, here's your paper money, we want the physical gold. And so he had no choice but to say, okay, that's it, no more convertibility of our dollars into gold. And so I think from that period of time, which is 50 years now, we have had effectively free-floating paper fiat money system, which has got no real backing. It's by and large, I think it's worked okay, but there's definitely a lot of cracks in the system. Yeah, so in many ways, whoever founded Bitcoin, and obviously no one knows, was it one person, was it a bunch of people, who knows? Many people had been trying to work on a concept of a so-called maybe people's money, some type of currency that could be so-called produced digitally, and effectively, I suppose, outside of the government system. And it's obviously a concern, where and how does the government step in? But what we have now, for anyone to really step in, do you believe, because of the decentralized nature of it, such a huge component, It's not like this, it's not like there's a head office, there's a CEO of this. There's no one. So this is just a protocol that's obviously just running across a bunch of decentralized computers.
Yeah, and I think that's important just for everyone just to kind of get your heads around that one, is that the dollar before 1971 was backed by gold. The dollar or any currency really now is backed by a promise from government to be able to take that currency and convert it into goods. And Bitcoin is really backed by a consensus of open source developers that agree to the playing field. It's a bit like playing chess, that everyone agrees to the way that chess will be played. Now, you can say, as a single developer, that you want to have more pawns on the chess game, and you can set it out, but the chances of everyone agree to you is very slim. And so that's the way that a good analogy in terms of how algorithms and the code behind Bitcoin is protected by consensus of open source developers, the backing of the number of Bitcoins issued, and obviously that has a direct impact on the pricing of Bitcoin, which is not the case with the other, most of the other 1,200 cryptocurrencies out there. And that's probably the main difference. Let's quickly talk about investment case. If we talk about risk versus return, buying gold, buying bonds, or buying Bitcoin, what is the risk that we take for each of those three, and what is the potential return?
I mean, this is an important question, obviously, and we've tried to think about it a lot, but it's an ongoing process. Obviously, certain asset classes, as it were, are available, and Bitcoin is not necessarily that accessible. We sort of do view it more akin to something like gold in its physical format compared to Bitcoin. They do share a number of attributes from a sort of investment perspective, and I think the biggest one is limited availability, i.e. the scarcity factor. The second attribute that sort of comes into it from an investment perspective is it's not easy to produce. So, with most sort of commodities out there, you increase the price goes up, and suddenly there's a huge incentive to go and mine more. And there's availability, whether it be iron ore, copper, coal, whatever the case may be. That's not the case with gold. No matter, if the price doubles, it's not that easy to just go and pull more out of the ground. It's very, very difficult. It's not the same as coal or iron or copper or iron ore. And that's exactly the same with Bitcoin as well. So the price can double or treble. Bitcoin even more so, because of the difficulty adjustment, means that actually, irrespective of the price, it's price inelastic. No more can be produced. There's an algorithm which decides this is how many will be produced, no matter how much computing power you throw at it. So there's a high degree of correlation with gold in that respect. The other attribute that is commonality to, let's say, gold is the fact that it's a non-yielding asset. So unlike your property, commercial property, or your residential property that you rent out, or the company that throws off dividends, or let's say your government bond where you're lending to the government and it's throwing back an interest, there's zero yield. So it's a zero yielding asset, exactly the same as gold. Gold in its physical format is zero yielding. You buy the gold. In fact, with gold, you've got to pay money just to store the gold. So in that respect, very similar. I think many people, and that's why it's sort of viewed as digital gold. It shares so many attributes from an investment perspective, and that makes it difficult to think about for investors. It's a whole lot easier to have a yielding asset. You can discount the future cash flows and say, this is the value of my asset. I can see I can discount future values into a present value and actually produce a reasonable value of what it should be trading at.
If we talk about asset allocation, and investors do want to include Bitcoin into their portfolio, I think currently we see Bitcoin as a component of the alternative asset class within a portfolio. So that just means private equity, private debt, commodities, gold. And then I guess Bitcoin could also come into that area if someone wants to include Bitcoin into their portfolio. Ian, what do you think is a good and cautious allocation to Bitcoin?
Yeah, I think, there's different ways you can look at it from an asset allocation perspective. clearly believe the sort of investment case and say, okay, well, there's merit in this asset class in and by itself. With history over the last 10 years, ever since it started getting priced, I mean, it's been a exceptionally volatile asset in terms of pricing in dollar terms, but that volatility has paid off in terms of the returns it's generated. So if you assume those numbers, or if you even assume half of that, I think there's a use case to be included as part of the asset allocation. I think that volatility does scare off. Obviously, it's a huge factor which scares off investors in terms of including it. I mean, I would think at a total portfolio level, 1% should be a relatively easy allocation to include, irrespective almost of the risk profile, I think, of the investor. So that would be maybe 2.5% of that sort of alternative category, as you're saying. If you bucket your sort of 40% alternative category, maybe it's 2.5% of that category. At a 1% portfolio level, the asset could go to zero, and your portfolio is really not going to be impacted. But it could start, if left, and you don't have to look at rebalancing. But I mean, if left, it could double and double again before perhaps you need to start trimming it back at a portfolio level.
Well, great, thanks, Ian. That's great insight. I think just this one thing, that often people think about investing in binary terms. Often when I speak to clients, it's either want to go full out for something or completely ignore something. I think this is good insight just to understand what is backing the different cryptocurrencies and especially Bitcoin, and whether it makes sense for them. And if it makes sense, it doesn't mean that you have to go aggressively into something, but rather just know that it potentially forms a portion or small portion of the overall picture, because as we know, as Ian said, the volatility is there. So with anything, you do want to spread it. You want to spread your counters over, the portfolio of different counters, reduce the allocation, but it can form part of a portfolio and be wise in terms of using that as part of your portfolio.
I think investing is not about a binary. It is about probabilities. You need to look at every asset class in a range of probabilities, and it's exactly the same with Bitcoin. So there's a percentage chance that the thing goes to zero. Okay, well, you assign that percentage chance, and when you look at it in those terms, and then you can actually tone down the concern that you have about the volatility in terms of your position sizing in the portfolio, and it sort of matches with those sort of probabilities.
Good. Thank you so much. It was great talking to you. Thanks for the insight. I'm sure that all the listeners would also enjoy it.
Awesome. Thank you. All the best.
Hey, thank you so much for listening to our podcast today. You can find our content on wallstack.ca or on LinkedIn. I'm Vincent Hayes, and you've been listening to the Financial Wellness Podcast Series.